At every stage of a divorce case, particularly when writing a marital settlement agreement, there is an opportunity to deal effectively with tax consequences and avoid tax traps. In my book, Frumke's and Verts on Divorce Taxation, we provide sample tax clauses that can be included in a marital settlement agreement. These clauses will help to anticipate and control tax ramifications and avoid unintended consequences in routine and complex divorce cases. For example, consider whether to file jointly. When married people are separated, they have an option to file their income tax returns separately or jointly. Joint filing offers the lowest tax rates and allows them to pool their deductions, but it may expose a spouse to audit risk and penalties if the other spouse takes deductions that are disallowed or fails to report income. In a marital settlement agreement, divorcing spouses may decide whether to file their final returns as a married couple, jointly or not. Second, consider allocating the risk of joint and several tax liability. When divorcing spouses file joint returns, each of them is legally liable for the entire tax liability regardless of who earned the taxable income. So in a marital settlement agreement, they might want an indemnification clause that will allocate the risk. The indemnification clause does not tie the hands of the IRS, but it opens the door for a divorce court to fashion remedies if an innocent spouse is held liable by the IRS. Next, what about splitting up the tax refund or liability? The tax code contains default rules that apply to some situations, but it leaves loopholes that can be closed with an effective marital settlement agreement. When divorcing spouses settle their financial affairs, they should not forget to decide on how to split up a tax refund from a joint return or who will pay any tax due. Next, choosing which parent will claim the children. When parents get divorced, they might want to decide which parent will get the most tax benefit from the deductions for the children, such as the dependency exemption. This also might tie into filing status, such as head of household, which has more favorable tax brackets. A marital settlement agreement can determine which parent will claim the children. Next, what about designating payments as deductible or non-deductible alimony? Most divorcing parents know that alimony can be tax deductible, but there are some situations where it is more advantageous to have a non-deductible alimony payment, especially if it is front-loaded or tied to a child-related event. In a marital settlement agreement, parents can agree alimony will be tax deductible or non-tax deductible. Finally, what about avoiding penalties for front-loading? Alimony that terminates or reduces sharply in the first 2 years can be a tax trap for the unwary. This trap can be triggered unintentionally. For instance, if an alimony payor is excused from the alimony obligation due to disability in the first 2 post-separation years, the recapture tax penalty might apply. A marital settlement agreement should contain a clause that anticipates this contingency and authorizes the divorce court to fashion an appropriate remedy. Consider changes in the tax code or differing interpretations. Every year, fiscal conservatives promise to reform the tax code. If divorcing spouses have structured their financial bargain with due consideration to tax consequences, a change in the code could change the deal. A good marital settlement agreement may contain an escape valve, so to speak, that will allow the parties to renegotiate if that happens. The provision of a marital settlement agreement intended to allocate tax liability was upheld by the U.S. Tax Court in the Estate of Goldman case, 1999. There, a taxpayer and spouse entered into a marital settlement agreement, providing for 10 years of monthly payments at $20,000 per month, a princely sum for 1984. The agreement contained a clause designating the monthly payments as transfers of property under Section 1041 of the Code, and also a waiver of the spouse's right to receive alimony. So, the payor took alimony deductions for the first few years. Fortunately, the marital settlement agreement also contained an indemnification clause. So, when the tax court ruled that the agreement designated the payments as non-deductible, the spouse was not liable for additional taxes, interest, penalties, or legal fees. Tax consequences are pervasive in family law, so it is critical to consider tax clauses when drafting a marital settlement agreement. These clauses and many others are covered in Appendix 14 of my book. For family law help in Western Pennsylvania, call me. I'm Brian Virts, and for more than 25 years, I've represented all kinds of people with complicated child support and divorce issues. My law firm is a powerful team of lawyers dedicated to family law. In Pittsburgh and Western Pennsylvania, call me at 412-471-9000.